So I also should note, on that last question, if you're interested in the policy and the impact the election could have on solar and more broadly on energy and climate issues, come tomorrow morning, the first session of the morning tomorrow. I'm doing a keynote interview with Trevor Hauser, who's Hillary Clinton's lead energy policy advisor. So we'll get a little bit from him on at least what Secretary Clinton might have planned were she to win the presidency. So before we head into the networking break, we have 2 full days of a ton of really detailed content ahead of us talking about the specific mechanics of solar in energy markets and the technologies and the ways that the market is developing. We wanted to start by taking a slightly long-term perspective and sort of ask the question, what is solar going to look like over the next decade? And what are the issues that will enable solar to grow at a fast rate over the next decade? What are the potential risks that we may be facing? What should we be watching out for? And then hopefully this conversation can then sort of bleed into everything else that we talk about over the next couple of days. So I'm very pleased to have a really great panel here with me. We wanted to have a diverse set of perspectives on this panel to talk about these issues, and I think we've definitely got that. So beginning at the end of the line there to your right and my left is Stefan Kratz, who's the Vice President of Energy Technology at Sungevity. So it gives us the residential and small commercial perspective on the market. Alta Yen, who is the Managing Director of Investment Strategy at GE Energy Financial Services, so focused on financing solar assets and thus thinking about both those assets and how they'll perform over the long term and what assets she might be able to finance in the future. And then Matthew Sachs, who is the Vice President of Distributed Energy at National Grid. So he gives us the sort of utility perspective from a utility that's starting to do some really interesting things in DG, and so can help us sort of answer the question of what role utilities, or at least what role National Grid might play in the market. So Stefan, let me start with you. I want to do introductions by way of just asking you sort of, what is your role at Sungevity, and to what extent are you thinking about the future 10 years from now as opposed to the next quarter?
Sure, thank you. So my role at Sungevity is to look at where some of the technology is going. What's the integrated roadmap for the energy system for our customers? We always look at it from what's the value proposition for our customers, looking at the new technologies. I mean, you need a pretty integrated view, looking at policy, financing, what technologies are coming, and also sort of grid integration issues. I think it's something that's definitely going to be, solar is going to be facing. We see it in net metering. But over the next 10 years, we're really going to see a lot of how is solar going to be integrating with the grid, interacting with grid. So that's what we look at.
So you're looking at the way, so Sungevity is obviously a residential solar company. You're looking at things like energy storage and load control. Why does that job exist today at Sungevity? Is it because customers are demanding it? Is it because you're trying to look out ahead and get ahead of things like changes to net metering? And what's the impetus for taking this seriously today?
Sure, absolutely. I mean, as a company, you need to understand, I think it's at the source of strategic advantage if you can design your product and your product roadmap to get to where the market's going to be in the next 5 to 10 years. Also, there is definitely demand and interest in batteries. There's a lot of interest around that, and there's a value proposition after the sale of the solar to the customer, where there's now an established relationship with that customer. How can you expand upon that and offer new services to them? So that's in some ways an yet uncovered and unexplored area of where we can add value today. And so that's sort of what we're looking at.
Yeah, I think that's an interesting point. There's been a lot of talk over the years about upselling customers on additional services once they've gone solar, or theoretically once they've done something else. Like Nest could upsell a customer on solar once they've installed the smart thermostat. Are you seeing that actually happen already, or is that just sort of in the works?
We are starting to see elements of that. We're seeing that in storage. So we're seeing we're introducing battery products to our customers this year. We also work internationally. We work in Europe, and things that we've seen there is the ability to offer installation services through partners to our customers in Europe. So they are the early signs of that happening.
Great. Let's move on to Alta. So tell us what you're thinking about day to day as it pertains to solar, and how you think about a decade from now.
Sure. I head investment strategy at Energy Financial Services. For those of you who are not familiar with our division, we have about $13 billion of assets under management. We invest across the energy spectrum, so our portfolio is roughly 25% oil and gas infrastructure, 25% thermal, and then 50% renewable energy. In addition to being the energy investing arm of General Electric, we have a second mandate, which causes me and my team to be a little bit schizophrenic at times, and that is to support the industrial side of the house. So we work very closely with our wind business, with our inverter business, and with our oil and gas business, and trying to leverage the financial expertise that we can bring to the broader company. And as you can imagine, each industrial P&L has a target to grow, and so sometimes there's a lot of push and pull in terms of what's going to happen in the energy space. And solar has been a particularly hot topic as of late. We actually worked with Shell and GTM to develop a financing platform for C&I solar, is where we spent a lot of our time last year, and that is part of the current business that he mentioned earlier this morning.
So is that, to the extent that you're making investments in solar right now, is it primarily focused on C&I, or are you looking at other sectors as well?
So we are primarily focused on the U.S. We see the U.S. as being a great growth market. We understand the risk and return profile in the U.S., and with the ITC extension, it certainly helped. Our bread and butter has really been on the utility scale, and so we will continue to do that. But we see distributed generation being more and more important, particularly in the U.S. market, and so that's part of the reason why we decided to spend some time in that space.
And what form of investment are you typically making? Are these all debt investments? Are you doing equity, tax equity?
So on the utility side, we'll do cash and tax equity. We'll also do debt, but we found that the risk-return profile for cash and tax equity is better suited for us. On the commercial side, one of the challenges that developers have been facing is how do you come up with a financing product that minimizes the leakage? And so what we were trying to build was a product that takes construction loans, tax equity, and cash equity, and you kind of put it all into one product, so it maximizes the efficiency of financing.
And to the extent that you're thinking about a decade from now, 2026, I suppose, is it because you're thinking about the assets in which you are invested and worrying about whether they're going to perform up to expectations, or do you think about how the market is going to look 10 years from now? Or are they related?
They're related, so we think about both. Like I said, because we invest across the energy spectrum, we think a lot about what are the risks and what are the challenges going forward. And I think this is where you're kind of going. One of the things that we think about is what's going to happen on the gas side with such low gas prices, and you think about technology being developed on shale plays and turbine technology. I mean, we've talked a lot this morning about how solar costs are coming down, but we see costs coming down in other types of fuel and other types of generation as well. And so how do they compete, and what's the right kind of fuel mix to be most efficient and be the best supply mix for the demand needed?
Right. I want to come back to that, I think, in a bit, because I think that is one of the bigger, longer-term questions about solar and even assets that we're putting in the ground right now. Like, what happens at the tail end of that project's life, and how does it relate to other technologies and what the cost looks like? But in the meantime, Matthew Sachs, so, what are you doing at National Grid?
So I run a team in National Grid that's really exploring ways we could be a greater participant in a more distributed future. I think we're convinced that we have several scenarios, but convinced that distributed generation and distributed energy would be a greater part of the future. And how can we be more active, and what is the best way to kind of walk that staircase up? To answer one of your original questions, it is a longer-term horizon, let's say in the 10-year horizon. That's not to say we're going to wait 10 years to do something, but more to say that we're looking to see, as this evolves over time, how we could, in some ways, future-proof our business.
So what part, are you operating within the regulated utility National Grid? Are you part of an unregulated subsidiary?
Yeah, technically I roll up into the business development team, which would not be part of any of our regulated distribution utilities. Okay,
and it sounds like you guys you're strategizing and ideating around what it might look like for National Grid to get more involved in DG. Do you have anything you can say at this point about directionally where you think it makes sense to head?
Yeah, I can speak a lot to that. Depends on how much you guys want to listen. But to put it simply, we're looking at multiple technologies. I think solar is high on our list due to the scale and the customer penetration it has right now. certainly looking at energy storage. But looking 10 years down the line, we see it coming together in many ways, where you have a network of distributed and, of aggregated and optimized DRs within an ISO that could turn around and provide grid services or other services outside the original intent. So looking at ways to enter, and that will certainly evolve, and those markets aren't well defined now, to say the least. But looking at ways that we could walk that step up there.
Great. Stefan, let me ask you this, I guess, to start, and then I'm interested in everybody's perspective on this, because, you know, I mentioned before, Tom mentioned, we've sort of all mentioned this convergence of technologies. It's what you spend a lot of time thinking about, this idea that 5 or 10 years in the future, we're going to have lots of dispatchable solar assets with storage, and load will be smarter and all these things. Do you have any worry that we're just all engaging in a bunch of groupthink about this, and that it's this little echo chamber in this room where we're all saying, oh yeah, things are going to get aggregated and smart and dispatchable, and it'll never really happen? Or are you pretty convinced this is where we're headed and we just are all right?
That's a great question. I think it's a great question. I think it's, I honestly would think the jury's a little bit out on that. The opposite pole of the idea of the aggregated, everything is controlled sort of scenario is the fact that I think there's, among consumers at least, and the residences and small commercials we work with, there's a really strong sense of independence and control over their own assets. A lot of the times when we sell solar, it's really about they control their own power, they control their own destiny in terms of pricing, right? They can predict what the pricing of their energy is going to be over the next 20 years. So I think that sense of independence could lead to an area where, or at least one of the dynamics is going to be, as solar gets paired with energy storage and controllable loads in the home, that becomes a more complete system in the home. It also can help mitigate some of the risk around net metering. I think that Hawaii is a great example of where things can be headed, and the pressures that are put on a solar-only system versus a sort of a self-supply system. So there is obviously the larger picture of aggregating all these devices, but apart from that, I think there's also a really strong trend around, if we're talking about a decade, self-supply and devices in the home that are all sort of talking to each other and in some ways create their own microsystem. There's a self-supply component there before getting to is it all controlled and somehow aggregated. I think that's an equally powerful dynamic we're going to see the next 10 years.
Right. Matt, what's your sort of perspective on this? Are you pretty sure that's where we're headed, or are you just trying to figure it out?
I believe in long term that economics drive change. And what originally attracted me to this concept, and give me a little liberty on the numbers because about 3 years ago, but I was looking within a capacity market, and there was 13.2 gigawatts of capacity there. And a lot of these peakers and other plants that served this market were quite old and had replacement in the next 5-ish years. And when you went down that capital, if you looked at the top from, say, 13 gigawatts, that 200 megawatts to 13.2, and just did some back-of-the-envelope math with excluding fuel costs and everything, you were winding up, they ran for less than 6 hours a year. And this was the duration curve. And, some back-of-the-envelope math showed that roughly translated into like $15,000 a megawatt hour, which was the first thing that just caught my eyes, like, wow, we could do this cheaper with anything. And you go down, and I think the big challenge is how far does distributed generation go down that stack. If you went to that 12 to 13 gigawatts, the rough numbers were something like $5,000-$6,000 a kilowatt hour, and if you went down to that first gigawatt, it was like practically free. So at some point, and the harder question to ask, where does that line drawn? But there is policy that needs to happen, and regulators are aware. You've seen in New York with REV, they're trying to tap into these things. And there's a ways to go to enable this market, but I believe if we're looking in the 10-year, we'll figure it out.
Yeah. Elta, have you looked at any portfolios of or individual like solar plus storage assets from a financing perspective? I mean, how do you think about this?
So we're making progress with Current in terms of trying to solve that. We've looked at a number of opportunities, but frankly speaking, on the storage side, we haven't seen the technology advance to the point where we're comfortable. We're a long-term investor from a financing perspective, so we're looking for something that's going to be around 10 years out. We want to know that the product is going to continue to work. We're going to want to know that if it breaks, that there's some kind of warranty to back it up. And that's critical to financing any kind of project where there's storage and solar combined. And we just haven't really seen a solution that fully wraps all the key risks associated with that.
Gotcha. All right, I want to talk about risks. And so if we're thinking about sort of the next 10 years, and our baseline is that solar is going to grow a lot over that 10 years, what is the biggest risk to that growth? Like what keeps you up at night as you think about this market? I guess I'll start with Stefan and then move back down the line.
Yeah, the biggest risks from our perspective as a residential sort of solar and energy provider would be policy certainty. That is, I think, at the bedrock of growth, boom, bust, all of those things, policy certainty and the ability to see 5 years out, 7 years out, as you pointed out, the ITC being able to having that clarity now for 7 years is enormous for the industry. Now it moves towards net metering and having certainty around that.
Do you expect to gain certainty around that? I mean, even the places where you see net metering cap extensions and things like that, they tend to only get you a couple years of certainty typically.
That's a good point. That's a good point. I think that the attempt or the efforts in New York are a great example of where if actors on both sides are getting together to come up with a formula that works, that will create certainty in and of itself because the actors are at least in the same room sort of talking. And so the band of uncertainty is much smaller than if they're sort of shouting across, from different rooms.
Right.
So it's probably a matter of how much uncertainty or what's the band of uncertainty, and the narrower that, the better for the industry.
Great. Alta, biggest risks to you, and I would love it if your answer has to do with what you were talking about before, with regard to natural gas prices and how that impacts the markets in the long term.
So I can make it a part of the answer if you'd like.
I'm sure that's what you're going to say.
Yeah, absolutely. Well, what I was going to say is I do worry about capital allocation and financing for these projects. I'm not fully convinced yet that we have the right financing products for the different asset classes of solar, be it residential, C&I, or community solar. I think there's a lot more risks embedded in these projects than people necessarily appreciate. I know that you showed a slide with declining PPA prices. One of the things that we're challenged with is how people come up with evaluations to actually pay for those projects. And some of it could be that other parties have a lower cost of capital, but it really comes down to assumptions that you're making about demand, about how much usage, about what post the PPA, what the residual value is going to be. And so when we talk about what are the competing technologies and what's going to happen with oil and gas, all of that is going to impact upon our longer term view as to how these projects are going to perform and what the cash flow to us will look like as an equity investor.
So to figure out a way to get to the question I really wanted to ask, you mentioned residual value and the post PPA. I mean, if I'm thinking about, to me, what seems like one of the biggest risks is to the extent that a lot of these projects are getting financed. They have a 20-year contract or so, and then they have to make some assumptions about what happens and what the value of those assets are and the revenue they can generate after year 20, which first of all is just a long time away, but also given increasing solar penetration, the impact that has on prices in the market. I mean, how much do you discount expectations about post PPA revenue?
So if you could just entertain me for a moment. I have a lot of people who come up to us and they'll say, oh, you have a contract, you have a PPA, so it's de-risked or it's low risk. And I would actually challenge that notion. So one is an investment grade credit today doesn't necessarily mean they're going to be an investment grade credit 15, 20 years from now. So that's one thing. Will a customer be able to pay? I think the second question that's been more challenging for us is, will a customer be willing to pay? So let's just say that technology in solar evolves such that panels are much more efficient, much more lower cost, and so that the rate that they're paying under their PPA could actually go further down. And so will a customer look for its terms and conditions of its contract and find a way to get out of the contract? That's something that we talk about. Another threat to the contract would be utility reform. So we've talked about what happens with tariff rates. And again, what's the impact upon the customer and what they pay under their PPA versus what they could get in the market. So during that 15 to 20 year period, we don't view that as completely risk-free. There's still risks associated during that period. You just happen to have somebody on the hook technically. Post PPA, we've been told that there are a lot of people who put quite a high residual value on, that they think the contracts will get renegotiated or re-upped at prices that are in their current PPAs, and we just don't hold that view. So the way that we look at these different projects is we actually take a merchant view, and we can do that because we have a view into the wholesale energy market, and we are investing in thermal assets. And that tends to be much lower than the retail values and what's embedded right now in the PPAs. We will, of course, do an upside and a downside scenario, and so you get a range of outcomes. But we don't think the residual values are as high as others purport it to be.
Great. Matt, what keeps you up at night?
Oh, God, my children. But outside of that, I think these are all really valid points, and policy changes are certainly a concern in the short term. Thinking a little longer term in the future, and what I worry about is how does the industry adapt to balance growth and growth expectations with risk management? We've seen a couple of, call them black eyes recently, but falls from graces a bit, and a lot of it was in search to continue to grow. I think there's still a lack of understanding of the sector in the general public or general investment public. I sat on a plane coming out here yesterday and listened to CNBC's take on solar over and over again, and why it's so correlated to oil, and it's another discussion. But these black eyes, I think, scare away potential investors. And I've spent some time on the private equity side, I've spent some time on the corporate development side, and as you're building this story, and we'll need investment to get to these next stages, and we'll need cooperation. I think it's imperative that the industry works to adapt to build the right risk management without killing what's made us so great in the sense that we continue to be able to innovate.
Right. All right, one more question from me, and then I'll open it up for a few questions from the audience, so get your thoughts ready. I think one of the sort of fundamental questions about the future of solar, if we're looking a decade out, is how we expect the mix of centralized utility-scale solar versus distributed rooftop or not rooftop solar. And it's there's a fair amount of infighting within the solar industry about this topic. You see little pot shots getting taken in sort of regulatory venues and things like that. But it's not an either-or question, but there will be some mix. And the question is, generally speaking, right now in the U.S., utility-scale solar makes up 60% of the capacity we put online in any given year. The other 40% is distributed. Do we expect that mix to shift, and in which direction? I can guess which direction Stefan's going to say, but please prove me wrong.
Well, go ahead.
Yeah.
I can only speak really actually more to the distributed side and the individual customer residential side. I mean, I think that market will continue to be incredibly robust. I think also what's really interesting and exciting is that we're starting to see some mixes of value propositions. Yes, there's an economic value proposition around solar, but as you think about energy storage, there's also an energy security value proposition around that. And you're essentially activating consumers' willingness to buy and pay for those kind of things. So I think that there is, over the next 10 years, when you think about energy storage, you think about smart appliances in the homes, things like that, there's an opportunity there to tap into more value for the customer. And I think that's another reason why distributed energy, distributed solar is going to continue to be strong in the sort of the consumer space.
Alta, you've invested in utility scale assets and now in DG through CNI. What do you think is going to sort of take up a bigger share of your time?
I think the utility side is just more cost effective. That being said, I think there's a certain class of customers that are naturally fit for distributed solar and distributed generation more broadly. One things that we were talking about earlier is I think hospitals and universities. So customers who are really looking for resiliency or they want dependable, reliable power, and who are going to be there for a long period of time. I think those are more prone for distributed generation, and depending upon their ability or their willingness to adopt to that type of business model, I think there's huge growth in the U.S. for that.
Your job title has distributed in it, so.
But I'm convinced both will coexist, right? I think they're very different businesses on one hand. They obviously share the same technology, some of the same policy, but but very different businesses that serve different functions. You know, utility will stay big, and some of the PPA prices you put up this morning, I think, illustrate that well. But looking on the distributed side, I think there's certain innate advantages on distributed generation, some that I outlined earlier, but there's security that we forget a lot about it, and having that. And this will often involve pairing with energy storage or some other dispatchable resource. There's also the value of D, right? And that's a hard value to come up with, but I think there is value there.
Value of D, by the way, is a term, if you haven't heard yet, you're going to start hearing all the time, but it relates specifically to the New York proposal and what's going on under REV in New York to estimate the value of the distributed resource to the distribution grid. That's the value of D.
That's right. And just building on that, distributed generation isn't all equal, right? I think there's certain parts of the distribution grid that it's more valuable, and I think one of the things that will happen as utilities evolve is at the very least there'll be a better flow of information between us and the industries, either by choice or in some cases per our regulators.
Right. Great. We have time for a few questions from you all. Don't be afraid. I see one up in front here.
I'd like to know Matthew's thoughts on what happens after the 20-year contract, and then kind of Alta, how do you guys come to the decision about the residual? You said you have a high case, a base case, mid case. How do you put it up to a vote, or who makes that decision?
So I'll just repeat the question so everybody can hear it. So the question was first for Matthew, how do you think about the residual value? We got Alta's answer on that generally, and then for Alta more specifically, you said you have sort of base case, high case, low case. How do you sort of figure out where you want to end up amongst those three?
Yeah, that's a tough question. I mean, there's no doubt about that. I believe there is value, right? Do I believe? Yeah. I have a similar approach as where we try to bound it. What if it's linked to what are you going to be competing against in 20 years? Are you competing against retail electric rates, or are you competing against this next solar project? And what does that cost in 20 years from now? And what's that levelized cost with inflation, without incentives? So we take a similar approach and try to bound that and really look to see what could be the worst case scenario. Separate from just the pure renewal value of the asset, I think there's value in that customer. And I've spent many, many weeks, if not months of my life trying to quantify the value of a customer. And if anyone here can,
That's
please.
the value of C.
The value of C, yes. We'll get through the whole alphabet before the panel's over. But yeah, and that's really hard. But there is value there. Quantifying it is a little bit of science, a little bit of art.
Alta, how do you?
So we do have an investment committee, so I guess technically speaking, a couple people have votes. One of the things that we look at is the return on and of capital. So during that PPA period, how much are we getting back? So if we feel with some degree of confidence that we're going to get a minimal return of our capital, or on and of our capital, we might be willing to take that bet where there's less pressure on the residual value. That being said, if you have an opportunity to invest where you're really relying very heavily on the residual value, that might be a harder thing to swallow.
Great. Next question from you all. Right here.
Just question to the entire panel. I'm curious about if you could comment on maybe the one or two enablers for that aggregation of that distributed resource and the optimization of those resources. What do you see as the maybe one or two blockers, or enablers? Is it the lack of standards, the lack of data and information exchange across the industry? Is it a software problem? Is it an analytics issue? Or is it more of a policy, where we're fighting the utilities and the regulators at this point?
Right.
So,
good question. Matthew, you want to start on that?
Yeah, I don't know if we're fighting utilities, and I think we're all trying, and the regulators, I think we're all actively really trying to figure out how to do it, and I do think I think there's lots of challenges, to be honest, but if I had to pick one, I'd say it's probably more of a regulatory challenge. And how do you set up the right incentives for the utilities, but also on the private side to make it a fair and right market. Technology, I mean, I'm convinced the software is and can be out there. But certainly, and it's also a cost problem, right? I mean, energy storage has dropped a lot, and it will continue to go down. And I think there's other technology that my heart is in energy storage, and I believe it. So don't take this the wrong way, but I do believe there's other technologies such as distributed reciprocating engines that have some potential to help solve that problem as well.
Yeah, and on the regulatory side, I mean, I think just to add to that, it is a challenge, right? Like right now in most of the country, you can't aggregate a bunch of resources and bid them into a wholesale market, for example. There's just like no mechanism to get revenue from that. So they're designing rules around that in California and New York and Texas. But, you know, it takes a state-by-state sort of regulatory initiative to allow you to play in those markets, right?
Exactly.
Stefan?
Yeah, I'll throw up another one, which is just clarity around net metering for solar and then aggregated devices like energy storage. We're coming up against in various utilities, there's not really a very clear way to treat energy storage and solar being on the same meter and how that affects net metering, and that's a major blocker to even get the technology out there. I think the technology will be there, as you say, the software, all of that, the aggregation of it is really actually in many ways sitting there waiting for the markets to emerge, and then also for clarity to be around multiple devices on the same meter and how that's treated.
And just to add to that, I would say, because we're taking different pieces of a puzzle and putting it together, really understanding the risks around each specific puzzle piece, but then when we put it together in the aggregate, really understanding the risks associated with that and who's actually going to take on that particular risk or those risks.
Great. Well, that's all the time we have for this session. Before we break, let me just note we're going to break into a networking break right now. We've got a half-hour break, but then come back here. We have a few really fantastic sessions between that break and lunch, so you're not going to want to miss those. In the meantime, please join me in thanking our fantastic panel.